Anton is proudly carrying on the real estate tradition. And I grew up with parents that were developing and building buildings and building subdivisions and were self-taught in a lot of ways. And then there was this guy came along, Robert Kiyosaki, and he wrote this book. And I read this book when I was 19 years old, and I just thought, why is everybody so crazy over this book? This looks just like my house. And then it wasn't until many years later that I realized that I had been raised by poor dad, right, and poor mom. And I had one of the best educations you could ever get right there at the dinner table, getting those nuggets from them that you weren't going to get anywhere else, right? And so as I grew up, I began to see how you can build something and you can sell something. You can build something and create cash flow for it, or you can build something, build relationships, and everybody gets cash flow. And I just kind of evolved through that through my late 20s and my 30s and my 40s. And that's just kind of how I began to do that. And so I have Robnett Industries because I have several subsidiaries where we actually do the development, we actually do the ground up construction, we actually do the property management. So we're really vertically integrated to handle anything in the real estate realm, from I have an idea to I have a product to sell that's fully stabilized.
Yeah, yeah. It's a great story, obviously, in the real estate world. A lot of people read Rich Dad, Poor Dad, right?
Yeah.
And all the books that followed, including the Cash Flow Quadrant, which is also certainly an eye opener for many. And a lot of people have started to move away from their W-2 job once they realized in what quadrant they were in. So it's always interesting, right? We were just at the real estate guys event in New Orleans just
Yeah.
I think 2 weeks ago, right? Shannon, and obviously Robert Kiyosaki is always on everyone's mind, right? And how he was a key influence to many of the real estate investors that are out there, that are not just investing in REITs, i.e. the whatever is offered by Wall Street, but what is done directly as investments by investors, or then where we are very active in the syndication space, right?
Right.
Yeah.
Yeah, and that's an important thing to look at is, what is going on in the other markets and what is going on in the syndication space, and who are you getting together with and who are you networking with. And it was really great again to see you there. I saw you at the in Belize, I believe, and several of the other real estate guys events, and it's just, I think it's amazing to see the quality of the individuals that you meet at events like that, and the information that's really coming out that's not Main Street media news, but it's definitely relevant to our industry, and is something that as entrepreneurs we definitely need to be paying attention to.
Yes, definitely. So it's you are really unique in that syndication space. You're based in Boise, Idaho, right?
Yeah.
So you have you mentioned you're a second generation builder developer. There are some syndicators that then have been branching out into developments. But you are unique because you and your family, you have been actually doing construction for a long time, right? So
Yeah.
the development side is not as new to you as it is many to the various syndicators out there that have just put their toes into the water, if you want to call it that way.
Right. Well,
Yeah.
and we've looked at it that we do the original value add, right? A lot of people, they look at it and you're buying somebody else's cash flow, and it makes it easier, and the bank likes it more. And well, don't you, Anton? I mean, you like it when somebody else is paying my bills, and you're loaning based on their wallets as well. Where we get involved in that space, where we see the need in the community and we get the land entitled, and then we construct the project, and we're able to take it really from just an idea to a completed stabilized product. And there's a lot of value in that. Plus, then you have the advantage of having brand new real estate.
Yes, definitely, and that is true today more than ever, right? We have seen property values going up every single year, and over the last year and a half, as everyone knows, they have exploded further. So now we are in a situation where in mid-80s properties are selling for more than a brand new construction in several markets. And yes, one can argue ground up development is riskier because you do not have a cash flow, and you need to properly assess the opportunity, and have to go through construction and lease up. But as long as you know the market really well, as long as you have done ground up construction, one only has to wonder whether it's really smart to buy into 70s and 80s assets that are priced above of what new construction would cost. And it's only the case in particular also in Boise, right? There are many markets that are overheated, but Boise is only on everyone's radar when it comes to property values and how they have exploded over the last year and a half.
But Anton, let's think about this. I mean, you're in banking, and so let's think about risk, right? Because that's all you guys do is you take and you quantify risk, and you say, I'm going to give you a 3% loan because there's not much risk. I'm going to give you an 8% loan because there's quite a bit of risk. And then I'm going to give you a 15% loan because there's a lot of risk, right? But when you really look at that, and this is the case I always make. So if I'm buying a value add deal in any market right now, even back in 2016, 2017, I was paying market for it. It was worth $10 million. I was maybe going to get a deal, and I was going to get it at 10% off, so I was going to get it for $9 million. But then I had to spend $1.5 million on it. So now, at the end of my time, I've now spent more money on it than it's worth. And if I happen to do that in January of 2019, then I walked right into the jaws of COVID with all of my dollars spent and a very small reserve because banking didn't think it was risky because I had this cash flow thing coming on. And then here comes the moratorium, and I'm sitting there with low reserves. Now, if you were to look at me as a developer, I would come to you and I would say, Anton, I'm going to build this 100-unit apartment complex. I just did one. It was a 60-unit apartment complex. My costs were $5.3 million. My appraised value was $6.3 million. And you would have told me, like the bank did then, I'm going to give you 75% of the cost of the project. I'm also going to ask you, how long is it going to take to do? And I'm going to say, it's going to take 12 months. You say, I'm going to give you 18 months of interest. I'm going to include that. I'm going to loan it to you because I'd like to get the loan origination fees on that, right? And I like to charge the interest on that. But I'm going to make sure that you're safe, right? And so here we are, the guy that did the value add, he's chugging along. I'm doing my construction, I'm chugging along. And then we both get there. Now, when you look at what is happening in the value add space, you loaned me probably 80% of my cost to buy, so 80% of my $9 million, and then you probably loaned me 50 or 60% of my CapEx that I needed to spend. So you loaned me more than the cost of the building. And now I have problems because I have stabilized tenants. On my side as a developer, you only loaned me 75% of the cost of the project. So at the end of the day, I can rent mine by the numbers for 60% of market rent and compete with the value add guy and not have the structural problems that you would have. Now, obviously, Anton, that's just taking it from a lender's perspective. There's the risks of the developer and the GC and getting into problems like that and structural, all those other kinds of issues. But from a financing point of view, it's not as risky as everybody thinks it is because you as the bank want to make sure that your investment, and you know that development is risky, so you advance the interest payments to ensure that I am not at risk and not putting your money at risk also.
Yeah. You touched on it, right? The experience of the developer plays a crucial role, right? Experienced developers, they get financing. They have been getting financing all along, and that will continue because that's really where the key is, right? If you can perform on the construction side and if you can perform on the lease-up side, then obviously that project will be very likely a success, right? Yeah. So now it's also I think what is important to touch on is when it comes to these value add deals, when we look back over the last 2-3 years, a lot of these deals that have been presented as with year one cash on cash returns of 7 or 8%, and then year two at 9 to 10%, and potentially even above that in year three. When you look at those deals, and many of those are actually underperforming significantly, and that is driven by the rosy projections that the syndicators and buyers have put together in order to attract, obviously, their investors, because all the investors in that value add space, they have somehow set their target rate, cash on cash rate, at around 7 or 8% in year 1 and 2, and then hopefully getting up to the upper single digits, between double digits. And as a result, a lot of these deals have been very aggressively structured from a rent growth perspective, and that is obviously in a lot of instances that has not worked out. What you have brought up, right, when it comes to risk, it's also really important to understand, while from a lender perspective, these value add deals may make sense, right, because we have that cushion there as lenders. One, as an equity investor, really has to wonder whether there is that much of a cushion there, and how that compares from a return perspective once one removes all these rosy projections compared to a ground up development, right? Obviously, one item that everyone loves about value add is that they get their bonus depreciation and other depreciation right out of the gate, right? So I think also with that benefit, a lot of investors are willing to overlook some of the shortcomings in the deals because they just see that big tax deduction in the first year. It's just it's almost with ground up development. It's a deferred compensation, right? That everyone needs to recognize, but ultimately, it's really important that investors truly understand the risk reward that they get into with the value add and compare it properly with a ground up development. And I think with the value add, they tend to overestimate the risk on a positive side, whereas they have a more negative view of the ground up development. Again, assuming it's an experienced operator.
Well, and you know, Anton, if you look back at the deals that you've done with value add people versus developers, you would be able to look at most of your value add people as unable to do a development. You would not rate them as experienced enough to do that. The other thing, too, that a lot of people look at is, yes, you get your bonus depreciation right up front when you close. You get the same bonus depreciation when you finish the project and you put it into service. But there's also a lot more tax credits that you can get based on new construction, right? So there's the 45L, which is a tax credit. On the last $12 million construction project we did, we received $345,000 in tax credits. That's dollar for dollar against my tax bill, not depreciation, which may add up to 37%, right? A dollar of depreciation might get me 37 cents off my taxes, right? But this is dollar for dollar. So there's a lot there, but the reality is, and I think it comes back to you kept hitting it, and I love that you did that. the rosy projections. As a developer, I have to get an outside appraisal. So Cushman Wakefield comes in or CBRE comes in and they say, this is all it is. And this is what I love about people. They look at it and they go, man, the appraiser didn't give me what I wanted for my house. But appraisers are historians. They have to look backwards. They have to look at they have to find something that's sold for the price that you're asking for. And if they find something that's sold for less, that's all the better they can do. But it also keeps people like me grounded. Because if I sit here and play with my spreadsheet in my little office, I can get to $1 million a square foot, just change it a little bit and come back and look at it tomorrow. Then change it a little bit more, and I can make this thing say that we're going to be gajillionaires, man. But the reality is when you get that third-party appraisal that comes in and says, you know what, this is all that it's selling for, and in the worst-case scenario, if the market goes completely flat, because if you remember, Anton, January, February, March, April of 2019 were not only flat, they were down, right? Values were down in those 4 months, and it was a total anomaly, and it was weird, and we picked right back up after that. But during those time periods, man, we went not only flat, but we went backwards. And the bank loves to make that case and make sure that you're protected. And so the appraisal doesn't allow me to get as rosy as I want to be on my projections.
Yeah, excellent point. Right now, obviously, the argument is with the value add, particularly when you have bridge loans, and bridge loans are now more popular than ever. Primarily because it's hard to make numbers work with going in with an agency loan even for stabilized properties, but also because there is so much financing, bridge loan financing available in the marketplace. Obviously, they look at the as-is value on one hand, but they will come up with a valuation that is forward-looking. And that forward-looking valuation actually depends a lot on the projections, or as we call it, the pro forma. And no one really knows whether these pro formas will still stand. We will look back in 2-3 years, and then one can decide whether it was the right assessment today or whether one was off upwards or downwards. No one really knows. But that's essentially how these bridge loans are done. It's all based on forward pro formas.
Well, and you know that's true too, and it surprises me, Anton, how many people are doing deals based on needing to get to bridge loan to get it done. It reminds me of 06 and 07 when people were doing deals at any cost because they were doing deals at any cost, right? And they were thinking that that was the right thing to do. But the reality is there's going to come a time if you got into the deal and only your bridge loan would get you there, and you're hoping that 24 months down the road you'll be able to go to permanent financing. What if that doesn't work out? Then are you going to be extending your bridge loan? What if your bridge loan doesn't extend? Then you're going to be fire sailing on the market, and then you start the same snowball effect that we had in 2008, right? I mean, I don't want to go doomsday on anybody. I think that the housing market is going to stay robust. But I also know that lenders like to lend people into the poorhouse. And I know that most Americans will borrow themselves into the poorhouse, right? They will continue. I mean, I know a lot of people that the minute one of the spouses gets a raise, they get a new car, right? As soon as the money comes in, they've figured out a payment to go with it, right? But the reality is I think that people need to slow down and look at, are these returns really going to work? And I would make the argument that investors should reduce their expectations to fit a better return profile as far as being able to get there. And what I mean by that is if we go into the deal, Anton, and the only way I can make this work with 25% down or 20% down is to get bridge, but if I bring 30% down in, maybe I have 30% down, but I only have 80% financing, but I'm able to get permanent financing. I bring in more equity. It really brings down my return, but it increases my safety margin. Mm-hmm. And I would rather own all of my projects in 5 years then own 3 of the 5 I started with bridge financing, right? Because I got 5 deals instead of 1 deal, right? And I got out there and not all my projections worked, and the loans were due and I couldn't get them refinanced, and I had these structural problems. And so I think we're going to be looking at some interesting times, not because the values will fall, but because they didn't quite meet projections. And now when it's time to come off of that easy money, that bridge loan, there might be some issues.
Yeah, definitely. Right. Even if values stay the same, we still have debt service coverage ratios that need to be met. We have debt deals that need to be met. And if they cannot be met, more equity needs to be brought to the table. When you do a syndication, the last thing you want to do is do a capital call once you do the refinancing, right?
Yeah, that doesn't make you popular in anybody's camp.
Definitely not. But what you brought up about adjusting the expectation as investors, it's a very valuable point. Unfortunately, and I would say that is probably the space we are operating in. There are a lot of investors that are just not willing and or able to really do a risk return analysis. They have set their target at a certain percentage, and that's all what they're looking for. And they are not really evaluating a deal, whether it's riskier to achieve that return that you're getting on paper versus another deal that may come in at 2 or 3 percentage points lower, but the risk would be significantly lower too, right?
Yeah, exactly.
Yeah. Just to be clear, we do a lot of bridge loans on our side. We are not saying that bridge loans are wrong, but there is a difference between having a true value add deal where a bridge loan makes sense, and a deal where it's fully stabilized and one just doesn't get the leverage with the permanent financing, and then one claims to be a value add when in reality it is not, right? So these are the riskiest deals from an investor perspective. And the difficult part is obviously as an investor to identify those deals, right? Yeah. Also, I think with bridge loans, when you have situations like this, lower your leverage, right? So you do not have to go with 80% leverage on a bridge loan. We have done plenty of bridge loans now that are in around the 70% mark. And that makes much more sense, right? As long as you still have that value add element to it. So you have that cushion in there if things do not work out that well. But certainly the riskiest ones are the ones that have 80% leverage are fully stabilized. So
there's not any room for it to increase other than they're betting on the market to continue to carry them.
That's right. And right now, obviously, when we look at CoStar rent growth forecast in virtually any market, that chart looks very attractive, where they still forecast 8 to 10% rent growth.
Right.
Now, the interesting part is, and I bring that up as a reminder, looking back to 2019, the CoStar actually for most markets had rent growth contraction forecasted for 2020, and that was before COVID, right? So now obviously COVID created a completely different environment, but I think we may also have to wonder with the rent growth that we have already seen, whether all these rent growth forecasts that are projected, whether they are really realistic, or whether a lot of the analysts are a little bit too aggressive just because they have seen that momentum and they think that momentum will continue. It may, right? But again, it's a forecast. We just do not know.
And I think that's important, and being a survivor of 2008 and 2009, I think it's really forced me to look at it and say that I want to make sure that I have enough in there that I can comfortably get by.
Yeah.
You know, I mean, there was a lot of deals that were going to make me millions of dollars in 2006 that didn't in 2008. But if I would have had a more consolidated approach and had more things involved in 2000 in consolidated and had more wiggle room, if you will, more equity in the deal, there would have been a lot more deals that I kept through 2008 rather than watch somebody else buy them in 2009 and profit from them like I was supposed to.
Yeah.
Right?
Excellent point. Right? And that, just by the way, this is not just single family. That has happened in multifamily too, right? Multifamily investors that had to refinance in 2008 and 2009, they were in trouble, even if the property was cash flowing, because values at that point, because even though interest rates came down, cap rates moved up, right? Values came down. So just because of the value, the LTV wouldn't have worked out. So they had to bring equity to the table to do that refinancing. And if they didn't have that equity, well, the loan was maturing. What could you do, right?
Yeah. And I knew people that were in the position where they had built a house for someone. They were builders and they'd built the house and they had the contract. And the end buyer couldn't get the appraisal because, again, appraisers are historians. And if you said that you were selling this house for $200 a foot, but the one down the street just sold for $150, now all of a sudden that appraisal doesn't work, and now the cash that would be required to close, now the buyer can't buy, the seller can't sell. And now, you had that, and not that we want to dwell on that, but there needs to be, again, some more of that safety margins that we build into things, and where bridge can lead you to a place where you come to a dead-end street instead of being the bridge that it's supposed to be to get you from construction to perm, or from value add to stabilized. And I think we've kind of made it very clear that there's a great use for that, but maybe it's time to start looking at that a little bit more clearly and making sure that you do have that path to permanent.
Yeah, that cushion is there. Right? Yeah, definitely. So Shannon, you have been doing a lot of development, right? So that obviously has been your strength. But tell us a little bit more about what you have been working on the tokenization of your deals, and maybe you also can explain in kind of a layman's words what tokenization means.
So the reality is when you look at what the underlying issue is with tokenization, is that we are creating a digital security. So when you go to the bank, you sign paper documents, but you give them a secured interest in your property. Then you go to your equity people, your LP investors, and you give them, the digital copy or the paper copy. You do it through DocuSign, and they have an interest in there. But with digital securities, which is really what we're creating, is you're putting all of this information on blockchain technology. And as we all know, blockchain technology is a distributed ledger. So Anton, yesterday you might have looked at your bank balance at the bank, but there's only two people on the planet that know what that balance is. That's you and the bank. But what happens if something happens to the bank? And this is what has happened in the 80s, it happened in the 20s. The banks became insolvent and all of your funds disappeared. Well, by using blockchain technology and using digital securities, we're able to put that on the distributed ledger, which means that thousands and thousands and thousands of people have access to the information that knows that Anton owns a portion of this property and that the bank owns the portion of the property, and all of the information is there. So what we're doing is we're taking it to a place where we are helping syndicators put this information on blockchain technology so that it is written down and it's a distributed ledger that then allows for liquidity to come to the deal. Because let's be honest, Anton, syndicators don't want to deal with people asking, can I sell my shares or my piece of your project? Because syndicators, that typically happens where the person calls you and says, hey, now's not a really good time. I really would like to get my $100,000 back. And by the way, can I have the interest? And the syndicator goes, man, that's not what this is about. The document said it's that way, and it's that way. Because there's all the things that have to happen, right? You got to find a buyer, then you got to find the paperwork, and then you got to sign it, then you got to get the attorney involved, you got to do all this stuff. But through blockchain technology and a secondary platform that we've created, we are allowing for that liquidity to happen because we have people that want to sell and we have people that want to buy. And through that blockchain technology, we're able to record all that information, much like a title company does, without involving the syndicator, involving our cap table manager that keeps a record of that, and involving our transfer agent that makes sure the SEC is completely complied with on everything that they want. So now we've created this digital platform that happens, and now when you sell 50,000 of your 100,000 tokens in the Airport Plaza project, as a syndicator, I don't know. I don't care. But when I put my money in there to give my distributions to my investors, the blockchain technology follows that and says, Anton, you had 100, but you sold 50,000 to Betty, so I'm going to give Betty this piece and you this piece. And so it brings all that together so that AI, artificial intelligence, can do a lot of the things that syndicators we didn't want to do. And it allows us to very quickly, very easily stay compliant with the SEC and everything that needs to happen with that. So it's really a great, exciting place to be because it's going to really change the way that syndicators look at deals and the way that investors look at deals. Because we've all heard investors say, well, you know what, I'd love to get into that deal, but that's a 5-year window and I really want to get my money back in 2 years. Well, I can help you with that because the liquidity is there for the platform. And so really with that, we're working hard to introduce the platform to more syndicators and more investors so that they can meet on the platform. It's like the combination of Coinbase and CrowdStreet. They had a baby, it becomes this digital platform.
Yeah, excellent explanation, right? Certainly from an investor perspective, right? And you and I, we have been dealing with investors for a long time. If we provided liquidity in some of these transactions, they would have a much stronger interest in a lot of instances. Some, they do not care whether it's locked up for 5 years or even more, but I would say a majority would agree that yes, I may be happy for 5 years, but if I can sell much earlier, then I'm certainly more comfortable to invest, right? So,
well, and you know, it gives you a sense of control, but you know, right. there's really two kinds of investors. There's the appreciation investor, and there's the long-term cash flow guy. And it allows you to say, hey, Anton, I see this value add deal you're doing, and there's a lot of money that can be made in the front of this when you take this really rough class D and you're going to make it a class B, and that's amazing, and I want to participate in that, but I don't want to get the return for a long, long time. I just want to create the value and then go ahead and leave. If that's okay, this solves that problem, right?
Yeah,
and so
the quick upside that hopefully will come, we don't know, right? But that hopefully will come, and get out of it and get into another deal where you have a similar structure. And you may have other investors that just do not feel comfortable with that so-called value add proposition initially, want to see whether a deal actually can be positioned and stabilized, and then buy into it through buying that token.
Right. And that's really, you know, the other thing that we're looking at is when people look at it and they say, well, you know, Anton, this is your first deal. I don't know that I mean, you know, I just want to make sure that you can execute on your business plan. When you're able to do this and you're able to show that I executed on the business plan, the guy goes, oh man, that's great. I guess I'll get in on the next deal in 5 years. This allows you to introduce them to that liquidity much sooner than that. And for them to say, you know what, I made a mistake. I can do this with you and I can get in now and we can have this conversation and everybody can be happy, right?
Yeah, absolutely. Right. the beauty about this is, like you mentioned CrowdStreet, obviously it has to grow, right? Initially, there are not that many deals on a platform, but as a platform grows, there will be more deals that have already a history of 1 year, 2 years, you name it. And that can become very attractive for investors to look for, again, when you have more a cash flow driven investor that may find a deal that is more attractive than what is currently available by anyone that is offering new investment opportunities.
Yeah, and I think it just opens it up so that people can feel like they're in control. You know, being the sidecar or the LP investor where you're just along for the ride and everything with no real control. Then it takes on a different feeling when you say, you know what, I can do what I want. I can make sure that I can do anything with this that I want. I can leave it anytime. Obviously, we're assuming that there are other people looking to buy it, but that's usually the case. If the business plan has been executed and everything is happy and everybody's doing well, then there's usually people that want a piece of that, and that's the marketplace that we're creating. And so I'm super excited about that. You're going to see more and more roll out about that. But if you wanted to go see what we're doing, it's at myverticalequity.com, and you can see what we're doing as far as launching those and seeing how the deals are coming together and the liquidity is happening.
Yeah, that's great. So I hope our listeners have heard that. Maybe you can repeat it one more time.
myverticalequity.com, and you can see the greatest part about this, Anton, is in order to even get to the platform to see the deals, you have to create your own profile that allows the syndicator to get your KYC and your AML, which is your know your client, and your AML is your anti-money laundering laws. So it takes care of all of that for the syndicator. It takes care of all those records. It takes care of making sure that the people that are in the ecosystem are the right people that need to be there, that are approved to be there, you know, that are allowed to be there, so that you're not worried about chasing down those records after the fact, right? Before they even see your deal, we've got their information, and we know who they are and their social security number and their W-9s, and all those things are all taken care of on the front side. It helps things stay pretty on pace and not get too goofed up.
Yeah, that's a very important piece to it, right? KYC. Yeah. AML, obviously it's on everyone's mind when it comes to blockchain and cryptocurrencies, right? Where obviously a lot of governments attempt to crack down. So as long as that is properly documented, it creates a lot of it creates that safety net.
Right.
I also wanted to touch on, obviously, not all deals always go well, right? And some deals may not go well. That might also be on that platform. So I think it's important, similar to equities and bonds and even REITs that are publicly traded, ultimately prices go up and prices go down. You talked about choice. If you as an investor, you're not happy with the performance of a deal and you want to get out of it, it may not be the right time, but you still have the choice to offer it for someone to buy, even if it's at a loss for you, but at least you're out of it. And someone may say, well, I think I like this, I picked this up. So that's an opportunity that in a typical syndication would be extremely difficult to achieve.
Yeah, and that's the thing. Again, it puts you in control, even in control of your losses, because sometimes it is the right time to leave early, right? Yeah. So, and that's the thing about it, is just giving you the choice and giving you the liquidity to do what you want to do.
Yeah, great. So have you already put some of your deals on that platform, or are you just working on building that?
No, we've got the platform built. We've got several deals on there. People can go through that process, and we're going to actually, so once you've raised the money on it, then you tokenize it and you create the digital securities and you send that out. So it's kind of a process that, okay, we put the offering on the platform, it goes out, everybody likes it, they subscribe to it, and then we create the physical token, the digital token really, because it's not a physical token. And then you wind up with those digital securities for you, and you put them in your wallet, your digital wallet, and you have that. And now you can trade that, that Park Place token for that's how that will work.
Yeah. Okay. Excellent. So we talked about a lot about the benefits for investors. Obviously, for syndicators, the benefit is that it creates that choice for investors and more liquidity, which may help them to attract more investors. But I think a lot of syndicators are just overwhelmed with just even considering it, because obviously staying in the line that everyone knows of the traditional syndication is much easier to do than going down that road of actually learning to do it with tokenization. So can you touch at least a little bit on how you see it, what the additional efforts are that are involved for a syndicator to set that all up?
Well, and in reality, Anton, we're really looking to simplify the process. So if you were to come to me and you say, hey, you know what, I'm kind of new at this deal. Last time I did a deal, I raised $2 million. This one is looking for $4 million. And it's a little bit more, and the friends and family the circle's got to get a little bit bigger. We're actually able to come alongside you, and instead of being an upfront payment model where you come to me and you say, okay, it's $85,000 or $100,000 to do my syndication with my attorney's fees and my advertising fees and my marketing and all my legal and everything that goes with that, I don't have that much money, right? The platform is built on a monthly payment model. So really what we do is we help you come to the platform. We help you with your documentation. We help you with your legal documents. If you don't have legal documents, we can help you get those, and we can put those in the smart contracts, and we can do all that. We have a marketing team that helps you put out your deal, put it together, make sure that your offering memorandums are good and tight and beautiful, and make sure that your marketing is there. See, the whole platform is marketing for investors, so we're creating our own crowd to fund what comes to the platform. So we're really a place where beginning investors can come, beginning syndicators can come, syndicators that have lots of deal flow and could do more deals if they had more investors. So it's kind of a welcoming platform for everyone, and then you're able to get in where you fit in, where we can help you get your product launched, and then there's a fee for the ongoing hosting and the maintenance, but also it allows you a lower barrier of entry to get your product out there and get your project funded and then move forward to the next step.
Excellent. So for the offerings, you leave it up to each syndicator what kind of offering they want to do, right? So you're not restricting them to a particular offering model. It's up to them, right?
Correct. If you want to do a Reg A Plus, that takes about 6 months to get the legal paperwork filed. We can make recommendations on that. If you want to do a B or a C or a CF, we can help you get those documents in about a week. We can get those put together for you. We can get those loaded into the smart contracts, which locks that in, distributes that to everybody, and keeps that going. And really, Anton, smart contracts are not smart. They're just triggers. They're dumb contracts that you program that when these things happen, then those things happen. And so there's all those things that you can work through, and we can help you with that. So you can come to me and say, I got this really great project, but I don't know the first thing about it, the crowdfunding, the syndication, all of that, and we can help you put all that together and then put it on the platform and launch it to all of the investors that we have on the platform.
Yeah, that's great, right? So these smart contracts, obviously you need to set it up. You need to set up the flow, right, the system. But at least once it's set up, it's consistent.
Yeah,
which
exactly.
is very different from any other contract that is out there. Now, one other question I have for you, since you have already done some of these deals, how was the lender response? Obviously, some lenders are very skittish whenever they hear anything that is not traditional. What was your experience, particularly with the first deal that you did?
Well, the reality is the first deal that we did was an owner carry. But what lenders have looked at, and what we're working with another company that does this quite a bit. As you know, Anton, most lenders want to know that 20% of the equity is not trading hands at any given time.
Right.
And so as long as you're walking them through that as to how that will happen and who will be allowed to do what and how that trade would be restricted where 100% of the equity could change hands on one day. The lender goes, wait a minute, I don't want that to happen. And so you walk through those safeguards and put those in place for the lender. And that all happens when you're writing the document as far as this is now done and we're ready to get to the nuts and bolts of the lending. And then we just let their attorney, their secondary marketplace attorney, talk with the bank's attorneys, and they talk that attorney thing and they figure it out, and then everybody's okay with it, and you move forward. So it is something that has to be discussed, but it's not something that done in the right way is not a deal killer for your lender.
Yeah. So again, your platform is not is the service platform. The actual deal structure, including what that you mentioned, the maximum percentage, whether it's 20% or whatever it might be, that is again still deal specific, right?
Correct. So all we do is we are a place for you to host your deal. We are a place where investors can come and look at your deal. We're not helping you structure your deal. So if you come to me and say, I got this apartment complex, but what do I do now? I really can't help you. You need to know what you're doing. You need to have your underwriting done. You need to be, you need to have that part figured out. But as far as how to put your package together, how to get your investors, how to lock that in, how to have a digital security, we can definitely help you with that. And our goal, Anton, is in the next 12 months to create a digital bond so that we will be able to be your front side as well. So we will be able to tokenize the front side of the deal and that first position. But that's going to take some working through, and we're going to have several of these deals lined up on the backside first.
Sure, absolutely. Yeah. Sounds all very exciting, right? So congrats on moving faster than most syndicators out there, right? They are a handful, but it's still solely on the fringe. But when we look at what blockchain has been doing in some of the other industries, it's only the right path to go. It just takes some effort to get there. Right?
Yeah, no, you definitely have to think ahead, because you can't get behind on this, because if you're in front, everybody's chasing you, and if you stop, they're going to run you over.
Yeah, that's right. Yeah.
Oh.
Yeah, Shannon, that was a great discussion. Again, appreciate you coming on. Now, how can our listeners reach you?
Yeah, so you can reach me or our affiliates at shannonrobnett.com. If you're looking for the digital platform, you can go to myverticalequity.com, and we'd love to hear from you on both of those platforms.
Okay, great. Thanks again, Shannon. That was a great discussion. Obviously, a big chunk of it was about tokenization, but I think that's a topic that we will hear about much more going forward. So you're one of the early individuals that have been taking the step, right? So it's like one can argue it's still a little bit of the Wild West, but in reality, it's not. It's just that one needs to understand what it's really all about.
Yeah. Well, thank you, Anton. It was a pleasure to be on your show.
Yeah. Thanks, Shannon.